Patrick, do we expect a drop this fast, and how much longer could we get it?
Well, John, I think in the next probably 100 hours or so, maybe even sooner than that, the national average will breach that $4 a gallon mark for the first time in months. I think March 5th is the last time we saw a free handle on the national average. We're already at $4.09, so just 10 cents away. And I tweeted out something about $2.99 gas, and lo and behold, within an hour, two stations now in Oklahoma City are already at that $2.99 mark. And keep in mind, we've seen those sub $3 prices happen during price wars, but this would be the first time it appears a legitimate profit margin still at these stations in Oklahoma City. Now, very few motorists are going to see that, but what most other motorists are going to see is that sub $4 price happening on the West Coast. A little bit of a laggard, but areas are falling back under $5. Even California is likely to fall under that $5 a gallon mark in the weeks ahead.
Why did it drop so fast?
I think a lot of it is still what Pippa had mentioned, concerns over consumption. We are coming into the closing innings of the summer driving season. The EIA implied demand metric clearly disappointing, though GasBuddy data doesn't really agree with the decline that we saw. I think there are growing concerns that heading into a slowdown in the fall, you have economic concerns. Gasoline, probably the unwanted hydrocarbon going into winter, being preferred is diesel and jet fuel.
But that's a discussion of the demand. And of course, the other side of that is supply. And we keep hearing about how supply is so tight. We did a whole segment on, I think it was yesterday, potentially right here on this show on Power Lunch. So why is that not playing into the price of gasoline at the pump right now?
Well, if you parse out the hydrocarbons, gasoline, diesel, and jet fuel, it's really distillates, diesel and jet fuel, that are seeing very, very tight inventories. Gasoline has moderately improved. In fact, it's just a little bit below where it was a year ago. So certainly a much different fate here for lighter hydrocarbons like gasoline that appear plentiful. And again, recessionary levels would dictate more of a decline in gasoline consumption. And that's why there's still a lot of pressure on diesel, distillate, jet fuel prices. And that will likely stay, especially as we approach winter. Areas of the Northeast are going to start to fill up with heating oil ahead of the colder weather. And of course, Europe's challenges abound in terms of heavy oil as it heads into colder months as well.
We're often talking about hurricanes this time of year. We really haven't had any major hurricanes hit anywhere near sort of the big refining regions. Is that a risk, though, that we need to be aware of potentially that could cause some kind of a price spike or a price shock, at least in the short term?
Without a doubt, as we're getting closer here, about 2 weeks away from the peak, the start of the peak of hurricane season, that is absolutely a challenge that still could push prices back up. In fact, earlier today, forecasters at Colorado State University, prestigious for hurricane forecasting, did lower expectations slightly. This is not, we're all clear. There still could be a major hurricane. Of course, they're forecasting 4 major hurricanes to hit the U.S., Category 3 or stronger. If one of those storms ventures into the Gulf of Mexico at a time that refining capacity is still constrained compared to 2019, oil production, we really still need every barrel. If there is a shutdown from a hurricane, we could still go up in dramatic fashion.